Welcome to Echo45 Advisors monthly market and economic update. In this video, we'll discuss how markets and the economy fared in February and what the key takeaways are for investors. Markets declined in February amid tech sector weakness, with the Magnificent Seven dropping 8.1%. The new Trump administration's tariff policies sparked investor concerns, and inflation worries have risen as well. Major market indices posted losses, with the S&P 500 down 1.4%, the Nasdaq was 4% lower, and the Dow was down 1.6%, while bonds gained 2.2% and provided portfolio stability. However, it's important to remember that the markets also made new all-time highs during the month, so it's important to keep these recent moves in perspective. We'll spend the next few minutes discussing some of these themes in more detail. First, this chart shows the annual total returns for different asset classes. The S&P 500 is lower because Magnificent Seven tech stocks have faced challenges despite positive AI developments, while defensive sectors like healthcare, financials, and consumer staples led market gains. Meanwhile, bond markets performed positively as the 10-year yield fell to 4.2%, providing portfolio balance during stock market volatility. International stocks have also performed well this year across developed and emerging markets. Many of these asset classes have outperformed the S&P 500 year to date, highlighting the importance of portfolio diversification. Next, as this chart shows, consumer expectations for inflation have risen significantly, with 12-month projections increasing from 3.3% to 4.3%, and 5-year expectations reaching 3.5%. Other data show that inflation has returned to 3% according to Consumer Price Index, with food and shelter prices remaining elevated. The fear that inflation could re-accelerate is resulting in market volatility and uncertainty around Federal Reserve policy decisions. Hotter inflation means that the Fed would keep rates higher for longer, which is typically not what the market prefers. Finally, this chart shows the S&P 500 index alongside its trailing 12-month earnings per share. Earnings tend to track economic growth, and when earnings rise, investors are typically willing to pay more per share, leading the markets to rise as well. Recent corporate earnings show robust growth, with 18.2% year-over-year increase in the fourth quarter of 2024, the highest since 2021, with 75% of companies exceeding estimates. S&P 500 earnings per share are projected to reach $266 this year, representing 12% growth. Despite market volatility from various factors, strong corporate earnings remain a fundamental driver of long-term market performance. Investors benefit from maintaining discipline as conditions evolve across economic factors, technology developments, and other variables. Volatility is an inherent part of investing, but history shows that maintaining a balanced, long-term perspective is the best way to achieve results over a long period of time. We hope that you found this monthly update helpful. If you would like to discuss any of these concepts in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.